You worked hard all year. You've earned every dollar. But most high income earners overpay tens of thousands of dollars in taxes each year simply because they don't take advantage of what I'm about to share. In this video, I'm breaking down 12 legal IRS-approved ways to reduce your tax bill by December 31st. We'll cover deductions, credits, clean energy incentives, even alternative investments like oil and gas. And I'll give you a sneak peek at the new 2026 retirement contribution limits that just got announced. Stay until the end because strategy number 11 and the 2026 updates can literally help you save and invest more next year. All right, let's start with your adjusted gross income, or AGI, the single most important number on your tax return. It determines which deductions, credits, and benefits you qualify for. The lower your AGI, the less you owe. For example, if you make $300,000 and contribute $46,000 between a 401k and a 457b, your AGI drops to $254,000. And at a 35% marginal tax rate, that's $16,100 saved in taxes. Every dollar you defer pre-tax will save you about 35 cents. That's free money from the IRS. Now let's talk about the big one, retirement accounts, which I have discussed multiple times on this YouTube channel. For 2025, the limits are for 401k or 403b, $23,500 with a catch-up contribution for those who are 50 plus of $7,500. The 457b is another $23,500. Solo 401k up to $69,000 combined in your employee and employer. But here's your teaser. In 2026, these limits increase. The 401k and 403b, $24,500 with a catch-up contribution for those who are 50 and over of $8,000. Now that is a total of $32,500. And if you're 60 to 63, your special catch-up jumps to as high as $11,500, meaning you could contribute up to $36,000 from your paycheck alone. Now, the employer contributions push that total to $72,000 for those who are under 50 and $80,000 if you're 50 plus, and $83,500 if you're 60 to 63. So if you've been thinking of front loading your contributions, this is your signal to start planning now. 2026 will reward high savers, but 2025 deadline is your last chance to lower this year's taxable income. Now, markets go up and down, but those losses, they can work in your favor. Selling losing investments to offset gains, and you can deduct up to $3,000 of those losses against your ordinary income. For example, if you lose $10,000 on a stock sale, you can use $3,000 this year and carry the rest forward indefinitely. Just don't violate the wash sale rules. Avoid buying the same or substantially identical stock within 30 days. Take control of your losses before December 31st, or you might lose the chance for this year. Now, our next strategy just really warms my heart. That's because giving is good, and my husband and I give substantial amount to our church, to other organizations who really align with our mission and our core values. When you give, though, you can be strategic, and strategic giving is powerful. Instead of donating cash, donate appreciated stocks. You'll deduct the full fair market value and skip all the capital gains taxes. For example, if you donate $20,000 in stock you bought for $5,000, you get a $20,000 deduction and avoid paying capital gains tax on that $15,000 gain. If you want flexibility, open up a donor advised fund. You'll get the full deduction now and can grant to charities later. The wealthiest families don't just give, they plan their giving, and you can too. We're about halfway through, and the best part is still ahead. The strategies that actually put cash back in your pocket through credits and direct tax offsets. And if you are a woman in healthcare and you're like, okay, Brittany, all of this sounds good, but it's a little overwhelming. Then I want you to check out the link below in my description and set up a clarity call with me. Perhaps my financial coaching can get you on the right track to financial clarity and financial confidence. Now, number 5 is for those who are self-employed or run a side business. You can prepay deductible expenses like rent, insurance, or supplies before December 31st. You can also delay invoicing clients until January to defer income. It's not avoidance, it's timing. Taxes often operate on a calendar year, so you want to make these smart money moves before the calendar reset. And strategy number 6 is health savings accounts. HSAs are the triple threat of tax planning. You get the contributions that are tax deductible, your growth is tax-free, and all of your withdrawals for medical expenses are tax-free. For 2025, the limits are $4,300 for singles, $8,550 for families, plus a $1,000 catch-up contribution if you're 55 or older. But in 2026, these limits rise to $4,400 for individuals, $8,750 for families. So that's an extra chance to shelter more of your income and get to invest it tax-free. So you want to use your HSA like a stealth retirement account, not a spending account. So don't use it this year. Invest the money and then use it when your healthcare expenses increase. Now, my working parents, this one is for you, and this is the Child Independent Care Credit. It gives you up to 35% of $3,000 in expenses for one child or $6,000 for 2 or more. Now, that's up to $2,100 to offset your taxes. But here's where income matters. Once your income exceeds $43,000, that credit begins to phase down from 35% to 20%. So high income households earning above that threshold can typically still claim 20% of the credit, meaning that a maximum of $600 for one child or $1,200 for 2 or more. And if your employer offers a dependent care FSA, you can also contribute up to $5,000 pre-tax, reducing your taxable income and offsetting child care costs. Even if you're over the income limit for the full credit, combining an FSA with the reduced credit can still save you hundreds of dollars. And number 8 is clean energy credits. If you've been thinking about going solar, now is the time. The residential clean energy credit lets you claim 30% of installation costs for qualifying systems, panels, batteries, or home energy. Spend $20,000 on solar and you'll get $6,000 credit directly off your tax bill. But we know that these solar energy credits, some of them will cancel out by year end. So you want to make sure that if this is something that you want to take advantage of, you take advantage of it today. So remember, these aren't just deductions. They are dollar for dollar credit, and the IRS is literally paying you to go green. But again, this is going to change in 2026, so you have to take advantage of it before year end. And the next strategy is something that I talk about a lot in this video, which is alternative investments for oil and gas. Few people know this, but oil and gas partnerships can provide major upfront tax deductions. Up to 80% of your investment can be written off in the first year through intangible drilling costs. Plus, you can claim a 15% depletion deduction on production income and in some cases offset active income. It's not for everyone, but for high earners, it's one of the few remaining real tax shelters that helps us to use passive income and alternative investments to reduce our W-2 income. The next is to contribute to a 529 plan for your kids and your grandchildren. Earnings grow tax-free when used for education, and many states offer deductions for contributions. A $10,000 contribution at a 5% state tax rate could save you $500 annually just for investing in education. You can even front load 5 years worth of contributions to supercharge their growth. And if you have a side business or a consulting income, consider forming an S Corp. Now again, this is a decision that you should make with your tax accountant, but it can save you thousands of dollars in self-employment taxes. And depending on how you're using this and how you've structured your business, the type of business and the type of business activities, you can leverage the qualified business income deduction that lets you deduct up to 20% of your income if you qualify. Phase outs begin at higher incomes, about $380,000 for married filing jointly, or about $190,000 for those who are single. So you want to make sure that you check your tax bracket, check check your adjusted gross income and understand how much you might get. Again, this is not just structure, it is strategy. The right setup can change your tax life. And if your income is temporarily lower this year, then you want to consider a Roth conversion. We recently purchased a laundromat and we are going to leverage the bonus depreciation to offset some of our taxable income and do this Roth conversion for free or definitely lower than what we would typically pay. And if you want to learn more about that journey, you can watch this video here. So you'll pay the taxes now to enjoy tax-free growth forever. This is especially smart in years you receive smaller bonuses or you take time off. A Roth is a gift to your future self, and they will thank you for it. So tax-free compounding is unstoppable. So you should get started with that today. All right, so just as a recap, this is your year-end list. First, you gotta think about how can you lower your AGI, and that is by maximizing the retirement contributions. Then you gotta harvest those losses, give to charities strategically. You might consider prepaying your expenses or delaying some of your income, maxing out your benefits of HSAs, FSAs, dependent care credits, clean energy credits, oil and gas deductions, funding 529 accounts, considering transitioning to an S Corp and using those QVI deductions and Roth conversions and lower earning years. And remember, 2026 brings higher contribution limits. 401ks are rising to $24,500 with a catch-up contribution of $8,000 or $11,500 for ages 60 to 63. HSAs now for families are up to $87.50. And so this is additional savings to help you to reduce your taxable income and invest more in your family. So if you want to be ready for those 2026 changes, then hit the like button, subscribe to my channel. And if you're a woman in healthcare wondering how you can optimize your finances, then I want you to book that clarity call with me today. I have so much more in store for you about how to hire your children, about the changes to 401ks. So definitely hit that notification bell so you can get notified when those videos drop. Well, that's all that I have for you people. Thank you so much for watching this video. Feel free to share it with a friend. It would be much appreciated. Put a question or comment down below. All right, look forward to seeing you in the next one. Stay wealthy, people. Bye-bye.